Did you know that the real estate market is worth trillions globally, but only a small percentage of that is accessible to everyday investors? Well, there's a way to tap into this massive market without needing a multi-million-dollar fortune through real estate investment trusts, or REITs. Welcome to Factful Finance, where we break down complex financial topics into actionable insights. Today, we're diving into REITs, showing you how they work, and why they could be a powerful tool for diversifying your investment portfolio. If you're ready to get into the real estate game, stick with us. First, a quick disclaimer. This video is for educational purposes only. Any suggestions or apps mentioned are not endorsements. Always consult with a financial advisor for personalized guidance. Let's get started with the basics. A real estate investment trust, or REIT, is a company that owns, operates, or finances real estate that produces income. Think of it as a way for you to invest in properties like office buildings, shopping centers, or apartments without having to physically own or manage them. REITs pool together money from multiple investors to buy and manage real estate, and in return, investors earn a share of the income produced by those properties. Now, let's get into why REITs are such a great option. The beauty of REITs lies in their accessibility. Traditionally, investing in real estate required huge capital and a lot of management. But with REITs, you can start investing in real estate with as little as a few $100s, and they're traded on stock exchanges like other public companies. This means that anyone with a brokerage account can buy and sell shares of REITs, making them more liquid than physical property investments. For example, let's look at Liam, who's been interested in real estate but doesn't have the cash flow to buy properties himself. Instead, Liam invests in a REIT focused on healthcare facilities, which pays regular dividends. He's not just earning from potential property value increases, but also from the steady rental income. But before you dive in, it's crucial to understand how REITs are taxed. The good news is that they have a special tax advantage. By law, REITs must distribute at least 90% of their taxable income to shareholders, which means they don't pay corporate taxes as long as they follow this rule. This often results in REITs paying out high dividends, which can be attractive for income-focused investors. However, the downside is that these dividends are taxed as regular income, not at the lower capital gains rate. Now, let's get into the different types of REITs: equity, mortgage, and hybrid. Equity REITs own and operate income-producing real estate. Their value is directly tied to the properties they own, like office buildings or shopping malls. If the property values increase or rents rise, equity REITs tend to see growth. Mortgage REITs, on the other hand, invest in real estate loans or mortgage-backed securities. Instead of owning the property directly, they earn income from the interest on loans. These can be a bit more volatile since their performance depends on interest rates and the state of the credit market. Hybrid REITs combine both equity and mortgage strategies, giving you exposure to both physical properties and real estate loans. Sophia, for example, has a portfolio that includes both equity and mortgage REITs. She likes the stability of the equity REITs for steady income and the potential higher returns from mortgage REITs when interest rates are favorable. But here's the important part. REITs aren't risk-free. Like any investment, they come with risks. Market fluctuations, property value dips, and interest rate changes can affect REIT prices. It's also worth noting that because REITs are required to distribute a large portion of their income, they often don't reinvest in growth as much as you might see with other types of companies. This can be a disadvantage if you're looking for capital appreciation rather than just income. So, who should invest in REITs? REITs are a great option for investors who want to add real estate exposure to their portfolios without the hassle of property management. They're also suitable for those seeking steady income, as many REITs offer higher than average dividend yields. Consider Benjamin, who's nearing retirement and looking for a steady income stream to supplement his pension. He invests in a diversified mix of REITs, which provides him with reliable cash flow from properties across various sectors like healthcare, retail, and industrial real estate. REITs can also be a powerful tool for diversification. By including them in your portfolio, you can reduce your exposure to the ups and downs of the stock market, since real estate often behaves differently from other asset classes. This is particularly important for investors like Noah, who's looking to protect his portfolio during times of stock market volatility. Now, let's wrap up with some final takeaways. 1. REITs allow you to invest in real estate without owning property. 2. They offer diversification and regular income, often through dividends. 3. They come with tax advantages and specific risks, so be sure to understand what you're getting into. Therefore, as with any investment, make sure to do your due diligence or consult with a professional to find the right REIT for your goals. So, what's the first step you'll take toward exploring REITs? Let us know in the comments. Thank you for watching this video on Factful Finance. If you enjoyed this content and want to stay informed about practical, data-backed financial tips, why not subscribe and click the bell so you don't miss out on future videos. We think you'll find the video on how to diversify your portfolio particularly useful for your financial goals.